Whatever stage you're at with your trading, it's important to stop and gain perspective before planning your next move. Take a break from the charts and join in the discussion with our hosts, Jason Graystone and Akil Stokes, as they share insights, opinions and expertise on all things trading. Grab a coffee, pull up a chair and join the Trader Coffee Break.
Well, welcome back to the Trader Coffee Break. I'm Jason Graystone.
I'm Akil Stokes.
And we're back for another week. How quick has this week gone, Akil?
It's too quick. Too quick. Way too quick. Life goes too quick.
Yeah. It really feels like yesterday that we were doing the Trader Coffee Break. It's gone so quick. And excited to be back. We're going to be talking about another important topic in trading today, and that's risk management and position sizing. So rather than talk about money management, money management's maybe another thing that we talk about down the line, and it is different. Money management's about optimizing your account growth, whereas risk management and position sizing is about really not losing money and how you focus primarily on not losing money to develop a profitable edge, add that to your trading edge, your trading plan, which we were talking about last week. And I guess what it'd be good to do is just talk about why is it important? Why is risk management and position sizing important? What would you say to that, Akil? If someone just said, "What's this risk management thing?"
Yeah, I thought you started off perfectly with separating two, how there's money management and risk management, and they do blend together, but they're all also separate. Like, I love what you say, where like money management is, you think about that like being your wealth accelerator. Like, once you're doing the right things, once you have a consistent flow of profit coming in, that money management is what, boom, helps you take it to the next level. Mm-hmm. Risk management is the exact opposite. Like, that's what stops you from really going broke and blowing accounts. And if you think about kind of the journey of trading, you have to have proper risk management so you keep your money, right? If you keep your money, that basically means you don't go broke, you keep more of your profits. Then you can implement money management to kind of grow those profits. And what we notice with most traders out there is that they're super concerned, hyper concerned about money management, or they have this misconception that risk management, instead of using it to manage risk, they try to use risk management as money management, meaning that like, hey, if I just risk as much as I can, they don't see it that way. If I trade as big a position as possible on this said trade, I can make as much as possible, where in reality, they're just putting themselves in a position to lose as much as possible. And boom, one of the many factors that goes towards 90% of traders, or whatever that number is, failing. So I love that you put it that way. Risk management is super, super important just to kind of surviving.
Yeah, definitely. And I think I'd love to just kind of reel off a few things to think about when you're determining risk and position sizing and why you should care at all. And basically, the first one that springs to mind for me is what you just said, and it's basically all around when people go into trading, they're trying to get as high returns as possible, as quickly as possible. And I'm not saying like that is obviously that's everyone's goal, that's everyone's dream, but there is a flaw in that approach in trading, because it always down to your account size, and position sizing is a massive part of your rocky road or smooth road to consistent profits or consistent new equity highs. So the first thing is to set realistic goals, like understand what your account size is, kind of what your likelihood of, a percentage return on that account is, and then getting clear in your mind about what that looks like, because that's the first step, being realistic about what returns look like as a monetary figure in your account, and being happy with that, being okay with that. Because I don't know about you, Akil, but the first thing is like people get deflated when they're like, oh man, a 70% return is like only $700. And you're like, well, it's 70%. Like, you have to be okay with 70%. I would be okay with 70%. And
Yes,
it's about focusing on that.
It's tough because we see it all the time. It's a lot of people, and all of this, I love how it all blends together. I feel like we just spoke about like percentage returns and over time and kind of compounding and whatnot. But it starts with the unrealistic expectation where a lot of traders either don't know what to think, or have this false expectation of what a return should look like based on all the fluff that's out there. And that goes back to another thing, right? How do you know what you can realistically return? Well, that goes to what we always talk about with back testing. When you develop a strategy, you develop a trading plan, you back test it, and you have those figures, it gives you a range of like, hey, this is an idea of what it should look like if I actually execute this flawlessly in the market. And then once you have that information, then you can play around with different risks where you say, hey, what if I risked 1% or 0.5% or 2%? What does it look like? How does it increase my gains? What does it do to my drawdowns? And you can get that full picture of what it looks like. And, just following up on the risk management kind of discussion, a lot of people think that risk management is just your position size and you go ahead and you just pick a random position size. And there's a lot that goes into it. One is, you want to know your maximum stomach for risk, and it's going to be different for everyone. Some people are, they're comfortable risking 5% per trade. Some people are like, I would never risk more than 1%. Yeah. But I think when you look at it, you have to look at the full story because, yes, you're risking, if you're risking 5% a trade, and let's say your strategy says like, hey, I never have a bigger losing streak than 2 trades in a row. Well, that's something now you're more comfortable trading that. Yeah. If you're risking 5% a trade and you look at your statistics and it's like, well, there was a point in time where just like real bad time in the market, lost 10 trades in a row, you're down half your account. Like you're not going to be able to stomach that in real life. But unless you have that information, you don't know what that story fully looks like.
Absolutely. And then you're halfway down your account, you've got to make back 100%. And that goes back to setting realistic goals. Like how likely is it that you're going to double your account? Probably unlikely as a newer trader. Quickest I've actually managed to do that, but it took me about just under two years. So like literally just under 2 years. It's a long time. And you're right in what you're saying. And note this down if you're new and listening to this. Traders, the biggest problem is they overestimate what's achievable in 1 year, and then they underestimate what's achievable in 2 to 5 years because they get humbled. And you really just want more of a balanced 5-year view. That's what I would say to all new traders. And that kind of leads on to the next one, which you just touched on, is understanding your risk tolerance. And this is where we talk about the personalities of trading. Some people are happy to risk more of their account balance on one trade. Some people are happy to take a 10% drawdown. Some people have taken, I know one of my friends, Siam Kid, who you know, Akil, Siam Kid, he's taken multiple 50% drawdowns. Like that's just the way he is. He can just do that. But you can't teach that to someone. Like you can't expect other people to do that because it's very rare that you're able to do that and keep batting every single year like he does. And that's just a completely different personality type. And I would say 1% on any one trade, that's a great starting point. If that's all that you want to do, 1%. But just bear in mind that if you're in 10 trades and you lose all 10, that's 10%. That's 10% down. And then there's things like risk reward profiles. You could be happy losing more trades than you win because you've got 10 to 1 or 7 to 1 risk reward profiles. But then you just have to understand that the greater the reward to risk, the less frequently you're going to be right. And the more you're right over being wrong, the less reward you're going to get on each trade. So you'll have more trades, if that makes sense. That's fair to say. That's based on all my studying that I've done. That's what I've found on every system across the board. So that's usually what it is. And we've got at Tier 1, we've got a really cool little matrix that you can go and look at to kind of give you a peace of mind on where that is. The next...
I'll tell you this before this. Yeah. And I think one of the issues is that people, they don't understand the balance, right? We always talk about it's a give and a take. Like you said, you can't have, it's very rarely you're going to find a system with like a 10-to-1 risk reward with like an 80% win percentage, right? It's like,
you tell me about it.
Yeah, please do. Send us a private message. I'll drop everything and trade that right away.
Yeah.
But it's a balance. And I think most newer traders or most struggling traders, they just refuse to accept that balance. I remember speaking to a trader recently who was like, I want to trade with an average like 5-to-1 risk reward, but I also want to win 90% of the time. And I'm just asking like, well, why do you want to win 90% of the time? Or why do you need to win 90% of the time? Because I'm like, with a 5-to-1 with 90%, I mean, 90% in general is tough, but like with 5-to-1 and 90%, that's very rare. Like, would you be okay with 80% or 70%?
Yeah.
And they're dug into these numbers, but there's no reason for why. They're not pulling them from anything. They're not pulling them from stats. They're not pulling them from speaking to maybe other traders that use them. They're making them up in their mind. That's like, imagine starting a business and like you're doing your budget for the year, for the month, and you're just like, well, I think this might cost this, and I think I want to spend this. You're making up these numbers. Like, that's not the proper way to do it. Like, there needs to be factual facts, information behind the things that you're creating. And
Definitely.
People don't do that.
No, I know. And it's free and, it's easy to do. It's just boring, and people just don't want to do it. But that, unfortunately, boring equals profit. That's my rule for all business. Boring equals profit. Exciting equals volatility, emotions, uncertainty, and a roller coaster. And boring equals predictable, profitable, calm, poised, better and better and better and better. So, yeah, that's it. The next point I had written down here was for stop loss orders. There's a lot of stuff around there about don't use stop losses. You do need stop losses, mental stop losses, and all this kind of stuff. And we've covered this before, but just understand what a stop loss order is. Make sure that you do use one is what I'd say. And bear in mind what I'm saying is just based on working with thousands of traders now and just giving advice based on what works the most, because I've met probably 2 traders that successfully use mental stops, and even they're a bit edgy. And if I was to give you advice, I would say definitely use a stop loss. That's a fair thing to say, because you've got the highest probability of succeeding using a fixed stop loss and understanding why you've placed a stop loss where you have, and also understanding that a stop loss order is the same as an entry order and the same as a target order. They're all, you want to put as much effort and attention into analyzing that position for the stop loss as you do all of the other orders, because they're all orders, right?
Yeah.
Okay.
I never understood the concept, aside from like, if you're a longer term investor, the mental stop makes sense, but that's a different type of game. If you're sitting back like, I'm going to get out of Microsoft if it ever goes back down to like 30 or something like that. But you're holding those things for months and years. You're not, a individual kind of daily reaction to the market is probably not taking you out. So I get that from a longer term investment standpoint, but from a trading standpoint, where we're dealing with a lot more volatility, a lot more quicker moves, I always ask this question, like, why not? Like, what is the downside? Like, it's like, if you jump out of a plane with a parachute, guess what they have? They have the main chute, then they have the safety chute, right? Why would you purposely turn down the opportunity to have the safety chute? Like, it's there just in case things go bad. Like, so even if you're someone that is going to use quote unquote mental stops, right? Why not just put a real one there? And I know the old myths were like, well, the broker sees my stop loss and the broker is going to do that. And, honestly, right, get over yourself, right? The broker does not care about you and your small account. And the whole broker's out to get you thing is a complete myth. Your broker doesn't want you to go broke. Your broker simply wants you to keep trading. If anything, they don't want you to go broke. Yeah, they want you to keep trading because they collect the fee every time you make an order. So it's like, but I never understood it. Maybe it's a psychological thing where it's like, by placing a stop, I accept defeat. I never dug into it that much. That could be a thing. I think that's stupid, but it could be where it's like, hey, by placing an order, I've already accepted that. Yeah, like, and I don't plan for plan B because plan A, like no parachute. It's you. Yeah, and all it takes is one splat on the ground and you're done. But like you said, like if you're entering a trade correctly, if you're doing your analysis, you should be doing analysis on 3 different things, right? Entry, stops, and targets. Where do I predict the market to reverse out, and how can I get involved, right? Where is it likely to go if my prediction is right? That's where you want to get out at. Where should it not go if my prediction is wrong? That's also where you want to get out at, right? So the stop loss should be nothing to fear. It should be a thing where it's like, hey, this has confirmed that I'm most likely wrong. If I'm most likely wrong, I'm going to take a risk management approach and get out the market before I lose any unnecessary funds. And then I'll get back to analysis and look for the next opportunity. Like there's no downside. There's no negative to it. The secret is you're going to be wrong in trading. Like it's going to happen. Yeah. So when it does happen, just be smart about it.
Exactly. And what you said about like, you ask people like, why wouldn't you? I always say that about backtesting, and we're not going to go into backtesting, but I've never had anyone answer that question. Like, why wouldn't you? And I'm still waiting. I'm growing old, waiting for an answer to that. But maybe you guys in the chat can answer the question about why wouldn't you place a stop loss? Like, why wouldn't you? Got a lot of people in the chat today. Tony's in the house. Cade, Lewis, Chris, how you all doing? Boring equals profit. So true. Yeah, it's so true. Very, very true. The next thing I would say is leverage. So this is where people get over, this is all to do with position sizing and risk management. And we've spoken about this before as well. Leverage can be a very, very powerful tool, and you can definitely use it to your advantage, or as leverage, because that's hence the name. But you can also really increase your losses if you use it incorrectly. And a lot of people use it incorrectly. So it pays to understand what leverage you're using and why, and what impact that has not only on your winning trades, but on your losing trades, because that will be a massive, it's a massive double-edged sword. Particularly when you start trading some of these bigger pairs where they move, and before you know it, you're getting margin call, or you've wiped out your account, and you're dumbfounded. You're starting from the beginning. So I don't know. You got anything to add on leverage, Akil?
Yeah, I think it all blends together with the risk management. I remember that when I first started trading, this is back in, I think it was 2007. Here in the US, like there were no regulations for everything. So I think we had like 200-to-1 leverage. And that intrigued me about the market, because you're like, oh, I can take this much money and spend this much. And like in your mind, when you're thinking, like I didn't know anything about risk management, it's just get rich quick. It's like, I can make this much money because I got this massive loan that my broker has given me. And I think it was a few years after that. I think it was maybe 2009, 2010-ish. They implemented a rule here in the US that cut the leverage from 200-to-1 to 50-to-1. And there was this massive panic where it's like, how will I ever make money on 50-to-1, blah, blah, blah. We can't trade. Forex is going to die, all the fun stuff. And by that time, I was much more knowledgeable about risk management and everything that went in. And I looked at everything, and I had a panic moment for a second. And I'm like, wait a minute. I never actually used my 200-to-1 leverage, because that would be irresponsible of me to do that. Yeah. And so I always say that when people complain about leverage, I'm sure there is a level where, it's going to handcuff you from doing certain things. But if you have a 50-to-1, I want you to ask yourself this question, right? Why would you be using your maximum 200-to-1 leverage in the first place? Is that a smart decision if you're doing proper risk management tactics? Probably not. So the decrease in leverage, it's there to be available, right? But you're probably never going to use all of it, or you shouldn't be using all of it. So if it changes, it's not really that big of a deal unless you're, taking irresponsible actions in the first place. So I remember that because it was a massive panic, and I was just like, I'm talking to traders, and I'm like, oh, how do I explain this to them? And I did the math. I'm like, wait a minute, I can still do everything I usually did because I'm smart and I don't risk more than this much per. Maybe I can't be in 100 trades at once, but I was never in 100 trades at once. And life goes on.
Exactly. And I always think, like, just use common sense. Whenever the closer something is to free or a good deal, the more you're the product. So the more you're at risk, right? Look at Facebook. Facebook's free, but you're the product. You're the data. You're the information. And it goes with anything. Whenever anything is free, you are the product. And if you think about it this way, let's just say that all leverage is, let's just say the housing market, right, is allowing you to control a bigger portion of the housing market with a smaller amount of capital up front. And you still have to put something down. Imagine if you didn't have to put anything down, like these help to buy schemes and things like that. When they come about, guess what? You've got no say in the deal. You're paying massive interest. Like it's not your house. Like you've got no say over the claim of the house whatsoever. It's more erred on the side of their game, not yours. So the closer you get to having a really good deal, the closer you haven't got one.
Look at credit cards, for an example. Like, and so many people that are new to credit cards, where it's like, oh, I just got that email saying they upped my limit by another 20,000. I'm like, you realize that means because you're going to spend it and then you're going to pay more on interest. Like that's not good for you. Like,
they haven't offered this to everyone. They've offered it to dumb people that know are going to be irrational spending it. It's like they are clever marketing.
You're close to your limit. Let's give you more limit so you can keep spending. We don't want you stopping and reducing debt now. We want to keep that debt growing. So why else would they increase it as you get close to your limit? Like, come on now.
They said I was special.
You are there. You're their favorite customer. Oh man.
Okay. Well, jokes aside, I think the last point I had was monitoring your positions. Make sure you're monitoring your orders closely. As Lewis said in the chat, knowing your max drawdown, market conditions, really getting clear about your numbers, having your forecast, your projections, your Akil said earlier about business plan and knowing the trajectory and knowing the probabilities, and monitoring your positions. This is what you need to be doing as a trader. Like in any business, the first thing you're looking at is what's the lifetime value, what's the income, what's the outgoings, how are we upselling products, what's the profit over time. And if you're not doing that on your trading, then you don't have a business. You can't have any level of predictability or probability, and that then lowers your peace of mind. And then you're just like this animal-brained mess scattered around the markets, going around in cycles, like constantly. That system didn't work. That system didn't work. That system didn't work. And you're like, where's your your metrics? Where's your journal trades? And they're like, oh, I didn't do any of that. It just doesn't work. Well, when is it going to work? It's going to work when you start monitoring the positions, knowing the numbers. And the other thing about monitoring the positions, I just put out a video on YouTube today, is you get a feel for what's likely to happen more. You get a feel for the breathing patterns in the market. And even if you do get stopped out, guess what? You might just see, oh, hang on a minute, that happened again last week or last month, and that's happened 3 times now. Perhaps I should look at this. And now you can start going, right, I'll give it a bit more breathing room, I'll reduce my risk, my position size, and so on and so on and so on. You can't get better. You can't refine an edge if the edge isn't there in the first place, or it's just a snapshot edge that you paid for, to give you a strategy to run into the sunset. It's not going to happen. I think that's fair. Like, monitor your positions, know your numbers. And then if you do all of that, you're going to have a decent approach to position sizing and risk management. And we can talk about money management another time, but you're halfway there. Like, you're really halfway there. And it's not really a lot, is it? It's not really a lot. Like, you haven't got to do a lot as a trader. You've just got to do the boring stuff. And that seems to be what people don't want to do, which is why we rant about it over these coffee breaks.
Yeah, exactly.
We've got a show because people don't do these things.
Exactly. This show is brought to you by traders like you. It's No, you're right. You're right though. It is. It's people. It's trading is simple, not easy. It's the concept is simple, like most businesses. It's not necessarily easy, but it's we're blessed to be in trading. You need the least amount of startup possible. Like a lot of it is just knowledge and effort.
Yeah.
And it's the thing we repeatedly see in not just trading, but in other aspects of life is people just aren't willing to give effort. If they give a little bit and it doesn't pay off right away, which nothing of value does, then they go into the next thing, into the next thing, into the next thing. And you just you got to sit down and dedicate yourself and say like, hey, I'm giving myself a year. Yeah. Like I'm giving myself a year. I'm going to go through things the right way. I'm not going to rush. I'm not going to jump. And then just be patient with your results and don't expect massive results, but expect small ones, right? Movement in the right direction. Yeah. And I think like most of us, like it just at a time, it just pops. Like at some point it just pops and you're like, wait a minute, like when did I get good? And it seems like it's an overnight success type of thing, but you got good by all of the small things you were doing that entire year. And now the results are finally starting to kind of show themselves, right? The J curve is finally kind of made it past the zero mark and you're starting your upward trajectory. And more importantly, the lessons that you learned in that journey, now you start to feel it. You're like, oh, okay, now I get it. And then you never want to go back. Like I know you'll never go back to anything dumb because you see what it is. And that's just, that's why a lot of successful traders stay successful because of those lessons they learned along the way to success.
Yeah, and the same in business. They say that the most successful business people start their business when they're 45 years old, and that's because they've had business after business after business, and they've learned lessons and they've formed partnerships, and now they start a business at 45, and guess what? It just blows up because they've got all the right pieces. They're not doing the wrong things. They're not going down. They're not making mistakes. They're just, as the crow flies, which is why Jeff Bezos and people like that, they start these businesses so later in life and they just, they skyrocket. So do the same in your trading. In the comments, you can get a credit card in 10 minutes online if you want to close
yeah, you can.
Most banks want you to write to them to close it. I know. Crazy. In fact, I've got a bank account open right now that we've been meaning to close for 2 years, and they want me to go into the branch.
Oh, yes.
Do all this thing, and I'm like,
dude,
I haven't got time to go into the branch.
I'm the same as you. Like, you got to come in and sign these papers. I'm like, no, I didn't have to do this to start it up. Why do they make it as hard as possible? Yes.
I know.
Yes, I'm in the same boat, which reminds me I probably should go in and close that today.
Yeah, I know.
Just sitting there like whatever the minimum is in there so I don't get fined or whatever.
Yeah, I think we've got about £600,000 of $2 fees just for having it Anyway, all right, guys, it's been a fun one. I think next week we'll talk a little bit about, I don't know, you let us know in the comments. We had a big request in today's live room about managing emotions in trading. We could maybe talk about that. I think that's a really important one. Yeah. And it seems to be quite popular. Or we could get more technical on stuff. So just let us know in the comments. And if you've subscribed to this channel, thank you. Most people don't subscribe to this channel who watch the videos, which is crazy. So subscribe, share it around to anyone you think is going to provide value. And then until next week, take care from myself and Akil. And we'll catch you next week. Take care.
Thanks for joining us for the Trader Coffee Break. Be sure to like this video, subscribe to the channel if you haven't already, and don't forget to hit the notification bell to never miss a live discussion. Follow our hosts on social media. And remember, do nothing to gain perspective on everything. See you next week.